This segment of Bridge Street is sponsored by Retirement Income Analysts.
The start of the new year means it's a good time to think about that 401k and whether it's a good time to contribute more to it. But with the volatile stock market recently, many of us do have questions.
Chip Coughlin of Retirement Income Analysts is here with some advice. And Chip, this is an interesting topic, particularly over the last few weeks because of the stock market.
Absolutely. We've had quite a bit of volatility, and that makes people a little unsure of the track they're going to be on.
So what should people do besides take a deep breath at this point?
Take a deep breath. Don't panic.
So don't touch anything.
Exactly. There's a lot of panic selling going on right now because they think the world's coming to an end. And really, the markets go up and they go down. And this might be a time where it goes down a little bit, 7 to 9%, but I think it's going to come back.
Okay, so you think it's a correction?
I think it's a minor correction. This was brought on by instability in China and the dropping price of oil.
Okay, so that's the biggest drivers. What other things should people be doing, not only because of the market, the way it's going right now, but the fact it's the beginning of the year? I think people should kind of reassess their 401k?
Absolutely. Number one, you should look at your allocation, check your investments, and see if they match up to your timeline. And when you're going to retire, that's your timeline, and the risk you want to take. So checking those is a smart move right at the beginning of the year.
Now, speaking of your 401k, you know, in terms of getting the biggest bang for your buck, I like to say, do you have any advice in terms of how much you should contribute?
Well, I tell everybody to put in the minimum maximum for starters. The minimum amount you need to put in to get the maximum match, if there is a match. But then in addition to that, I tell my clients, add 10% to that money every year, that deposit. So if you're putting in $30 a pay period, bump that up to $33 right now. 6 months from now, bump it up another 10%. It's pre-tax money. It won't hurt you that bad.
So, I mean, what's kind of a rule of thumb that people should be putting in percentage-wise of their salary, would you say?
Well, I tell people, do what you can do, but have a plan for the future. And like I tell my daughters at home, I said, start with 10%. Okay, you're going to get all the match.
That's a good baseline right there, 10%.
You're going to get all the match, put in 10%, but add to that over time. And as I said before, a small amount of money over a long period of time, you get an explosion of value.
And in terms of adding to that 401k, you're not sort of stuck in a certain specific amount of time frame that you have to, you know what I mean? Like if you want to next month increase it, you can. You don't have to do it. There's no time constraint.
In many plans, you can make changes to your allocation several times during the year, and you can make changes to how much money you have going in on an ongoing basis.
Good to know.
Okay, and back about the allocation, I know you're supposed to change it depending on your age. As you get older, you should become more conservative. But don't you also have to kind of keep an eye on how your 401k has done over the year, because that could mess up your allocation right there. I mean, if it's gone way up, you may have to scale back a little bit.
Well, it depends. We call it rebalancing.
Yeah, rebalancing.
Okay, you want to go in your portfolio and look at it and perhaps rebalance it from time to time. As you get 5 years out from retirement, your retirement date, you want to take some wind out of the sails or take some equity out of it and build up your bond position. Because what you want to avoid is a bad sequence of returns right before you retire. And it maybe that makes you work an extra year, not what you had in mind.
Take some chips off the table, so to speak.
Absolutely. You have to still have some equity in your portfolio, even in retirement, because you have to offset increasing prices and inflation by having some equity gains in there.
There we go, some sound advice. As always, Chip, thank you. We want to remind you that if you'd like more information about retirement planning, you can visit them online, retirementincomeanalysts.com.
Okay, so we're taking our deep breath.
There we go.
Thanks, Chip.
Good job, thank you.